Well, good morning, everybody. And first of all, I would like to thank my colleagues and panelists for joining in this first thing in the morning panel, and would like to welcome and thank attendees in the audience. So we have an interesting panel today that is discussing financing transformation and uncertainty under the bigger topic of banking in Africa. And we have a very kind of exciting, deeply experienced panel. Unfortunately, Daniel, who is from I&M Bank Rwanda, could not join us because of flight logistics issues. If he had joined us, we would be representing the four corners of Africa, because we have colleagues from West Africa, South Africa, Todd and I based in North Africa, and of course, you have Nord, who is based in the US, but deeply experienced across the four corners of Africa. Also, my colleagues on the panel cover the whole spectrum of financing, from development institutions, commercial banks. Basically, I think with Olivier, we have something that is not very common in Africa, which is more capital market related, which is a big topic of actually how deep is actually African capital, or African capital markets. And of course, Njord represents equity and impact investing. So we cover the whole spectrum of financing, and we'll try to cover that in the questions. So instead of doing the introductions, I'll ask each of my colleagues to perhaps maybe introduce yourself, and just in a few minutes tell us about the organization you lead or represent, and the type of financing options that you provide various customers and consumers and institutions across Africa. So maybe we'll start from Njord next to me. So.
Sure. Good morning, everybody. I'm Njord Andrews. I'm one of the managing partners of Axion Impact Management. It's the investment arm of Axion International, which is a global nonprofit that's been investing in the financial inclusion space for about 60 years now. I've been in the impact investing space for about 15 years. Before that, I had about 10 years of experience in sort of mainstream finance. So Axion, we launched a digital transformation fund earlier this year. It's a private equity, $150 million fund focused on really taking investments into traditional financial institutions, whether it's banks or MFIs across the globe, and helping them really position themselves for the next 10 to 15 years with regards to digital financial services. As we all know, the fintechs have been doing very well at financing urban clients, young clients, and been really growing the space. And the traditional banks have been sort of lagging behind, and they need the support from us to help digitalize their products and digitalize their customers as well. So that's what the fund is focused on. We are investing across the globe, taking minority stakes, doing equity, some quasi-equity, and then we're looking to do more investments in Africa as well.
Thank you, Njord. Thank you very much. So Todd, of course, we're all very, very familiar with HSBC, but I think not all of us are familiar with the deep presence in Egypt, and perhaps what's the plan for the rest of Africa? So.
Sure. Yeah, awesome. So my name is Todd Wilcox. I'm the CEO of HSBC in Egypt. HSBC in Egypt has been in operation for 45 years. We're the largest multinational bank by a significant margin. We bank over 85% of the multinationals and corporates that are coming into Egypt from offshore. We've got a full service offering, so we do everything from multinationals to the retail. Altogether, we have about 350,000 clients, 55 locations. So it's quite an extensive operation. Egypt for us is a priority market, meaning that we get more investment dollars. And the intent is very much to expand. And we're seeing our corporate clients are really interested in Egypt as the launchpad into the rest of Africa, or for manufacturing them back to Europe or to the Middle East. So for us, it's a growing operation.
Thank you, Todd. Olivier, can you please tell us more about Africa Link Capital and the whole securitization market?
Thank you. So, good morning, everyone. My name is Olivier Guy. I am the managing director of Africa Link Capital Titrisation. So, titrisation in French, which means securitization. We have been operating in West Africa capital market for 6 years so far, and we deliver securitizations services to government and to corporate also. So we are the first private company licensed by the West Africa capital market regulator as a securitization fund management company. So far we have closed a dozen of transactions amounting at about 500 million USD for various players, from banking institution to real estate or electricity sectors. Our last transaction for which we are particularly proud is the first social bonds that we have issued on West Africa capital markets last year to provide electricity to households in the neighborhood of the Abidjan capital and all the rural areas. So these have been able to impact about 400,000 households and bring them electricity, so that our aim is to expand securitization in West Africa to both government and corporate, provide financial product to investors, both regional, West Africa regional investors, that international investors. For example, institutions like AFSIC or EIF, Emerging Infrastructure, African Infrastructure Funds, work with us to finance some of our project and invest in some of our insurance. So we want to provide this financial product to them, and also have a great impact on the social and economic development of the countries of our region. Thank you.
Thank you. Bakuzi.
Thank you. Good morning, everyone. My name is Bukosi Maluleke, and I'm from the Development Bank of Southern Africa. So the Development Bank of Southern Africa is a South African DFI with focus in developing infrastructure. So in terms of our approach to infrastructure, we look at it from the entire value chain. And that is, we prepare, we build, we finance, and we also maintain. So in terms of our mandate, we cover in-country and also across the continent, but with more focus on the sub-Saharan Africa. And in terms of our financing solution, we look at infrastructure finance through predominantly debt and equity, but we also look at it from various financing instruments, which we're going to touch on later as part of this topic. My role is that of being the head of treasury, responsible for making sure that the bank is well funded. So the bank fund itself currently using 3 currencies, which is the ZAR or the Rand for the in-country project, and the Euro, and also the USD for the rest of Africa project. So we have an active DMTN program registered with the South African Johannesburg Stock Exchange. We're a regular issuer there. And then we also raise funding, of course, through various means in other markets, developed markets, the Western markets, and recently we have also looked in new markets with, deep pocket of liquidity, including the UAE and others. So yeah, in a nutshell, that's us, and I'm going to hand over to...
Thank you, Bakuzi.
Thank you.
So as I mentioned earlier, of course, as you can see, if, my colleagues on the panel represent impact investing, with international experience, commercial banks with international coverage, capital markets and securitization, and development finance, and I represent private equity growth capital investing. So we cover the whole spectrum of financing. So maybe we'll start by the fundamental question that probably most of us on the panel in the room and attending this conference should ask ourselves, which is the first topic on the slide. And I'll direct this question to Todd, given your deep expertise in Asia before living in Africa, and having part of one of the largest banks in the world will have this global view on how various regions grow or face challenges. So the question is, can we bank on Africa?
Yeah, so having, I spent 4.5 years in China and 14 years in Southeast Asia. And the question when I was in China was, how could you not be in China, right? There was no option. And I very much look at Africa as starting to have that same, that same cachet. And when we look at the world and really looking at emerging markets and where do we see the new economy starting, and we've got 2 centers that we look at right now. And it's very much Asia and China-led, but more and more you're seeing Southeast Asia really start to come to the front as well. So Singapore, Vietnam, Malaysia, Indonesia, and then we look at Middle East, North Africa. Within that jurisdiction, you've got very different economies. So you've got Saudi Arabia. We've got part ownership of the 3rd largest bank in Saudi Arabia. But Egypt is really being the emerging market. So you've got UAE, Saudi, and Egypt. And Egypt, as I was saying, has all the right factors for us. It's got, and it represents kind of a country that looks very much like some of the other parts of Africa. Very young population. The median age in Egypt is 23. It's 110 million people. It's growing rapidly. Infrastructure is really built up in the last few years. So now we're seeing many of the big corporates looking at moving in or expanding their operation. And even for corporates that have been there for some time, this is all public, but you've got companies like Samsung that manufactures in Egypt, but is now doubling its manufacturing capacity for export. Beko, which is the Turkish appliance company, very large, expanding their operation, manufacturing for export. And you've got the population there, you've got the entry point into Africa, back to Europe or into the Middle East. So I do see, given the young population, given the growing infrastructure capabilities, I think you'd be crazy not to bet on Africa at this stage, and at least have an entry point in.
Thank you, Todd. So obviously, I think the 3 of us can go native because we are Africans. So maybe I'll ask Noor, given you are deeply experienced in African investments, but you are based in the US.
Yeah.
You cover multiple markets.
Sure.
And just looking at Africa relative to other places, can we bank on Africa?
Yeah, I think the short answer is yes now. I think from a private equity standpoint, it has over the last decade been very challenging to justify the types of valuations that has to be paid in Africa versus other regions like Southeast Asia or other Asia, South Asia even. And so what at least we've seen for the last 10 years is the multiples, the multiples that you're paying on the book value in Africa has steadily come down as I think, quite frankly, investors have become a little disillusioned about the returns profiles and the returns they've actually gotten from a lot of their investments in the banking sector in Africa over the last 10 years. But now we've seen, I think, a rationalization of the pricing, which leads to, at least from my standpoint, a real opportunity to come back and make equity investments into the Africa market.
Thank you. So I would invite my colleagues in the panel if you have any observations before going to the next question.
Yeah, I think from where we stand, and I'm actually speaking from a DBSA perspective, I think it's a yes, and given that, we are in the new era of ESG and sustainable finance, we have been experiencing a growing investors' appetite for ESG-aligned projects. And when you look at Africa, in terms of its, of course, climate condition, it offers you those opportunities, and especially when you look at the opportunities that it can present when it comes to renewable energies. For instance, we've been seeing some flow of funds into the DBSA, of course, with interest into those type of assets. So I think if you want to be that investor that is relevant with an impactful purpose, of course, without looking at, the commercialization and the profit matters when it comes to valuation, as my other colleagues has actually said, then there's definitely, room, for those investors to come and partner and bank in Africa, given the diverse opportunities that it actually presents, in relation to, climate-related type of infrastructure projects. And that is where the DBSA now is actually playing, a very big role, and our focus in line with our just transition strategy, has been to scale up, in terms of, making sure that we finance these green assets, and also, in ensuring that we green our portfolio in the long term. So there's definitely room for investing and banking on Africa.
Thank you, Vukosi. Given that we perhaps addressed this question of can we actually bank on Africa, I'll stay with you, Vukosi, on the second question, which, what are the financing options? Because many of us represent one form of financing, of course, as a development bank or a development institution. You have a broader spectrum. So can you share with us what are the type of financing options that an African business can tap into?
Yeah, look, absolutely. So there are absolutely diverse financing needs for the continent. Different sectors and projects require tailored financing approaches. But for infrastructure, from a DBSA perspective, both long-term debt and equity are very crucial. However, there are other forms of financing options that we have been looking at over the past few years or so, and we continue to look at those in terms of really diversifying our finance options. So our financing options also include traditional financing in the form of bilateral debt, right, from us to the government. So one thing that the DBSA does is that the DBSA frequently partners with governments in Africa and other DFI in making sure that they support large-scale infrastructure projects. And earlier on, I also touched on the issue of sustainable and green financing. So, we have sustainable and green, bonds frameworks, which we have used in the past to actually tap, or attract capital from various markets and various economy. And of course, this capital is use of proceed capital earmarked for specific projects. And this, again, in line with our just transition, strategy. These are some of the financing instruments that we also use in our side to actually make sure that, we attract green asset, we finance climate resilient infrastructure project. Over and above that, we have also recognized the importance of, guarantees and risk mitigation. When you look at Africa as a continent, I think for the longest period of time, we have been looked at, as a risk more than an opportunity. So it is very important as a DFI for us to actually make sure that, we play a very essential role in de-risking some of these large infrastructure projects. Why is this important? This is important because the moment you start using those type of innovative financing solution, you are also attracting, the appetite of private investors to come in and actually partner with you. And this is very crucial because it talks through to the aspect of private participation in line with triple Ps. So if you were to really stimulate investor confidence, and if you were to be really attract foreign direct investment, these are some of the things that you should actually make sure that you employ, of course, as a DFI, because you've got a developmental mandate, but over and above that, you play a very de-risking role in as far as financing infrastructure is concerned. And then there are other ones which, because of interest of time, I'm not going to talk into, such as capital bonds. I know that for some African markets, in terms of development, I think we've got experts that can really talk to that later on. But there's another financing instruments that we actually use, like project bonds, for instance. We get into the market to raise bonds for specific projects. This is very important because there are some investors that are very particular in terms of their interest and project that they're actually looking for. So that is very actually helpful in our case in terms of making sure that we diversify and we innovate in terms of, or in as far as actually, financing development is concerned from a DBSA perspective.
Thank you, Vakuzi. Maybe if we can get views from Todd, given that obviously Vakuzi is looking at it from a developmental angle and a defined region, and you also look at the defined region, but from a commercial angle. So what are the financing options available for African projects and African businesses that you can advise attendees on?
Yeah, I think there won't be any surprises in this, and I think it's a bundle of kind of financing instruments to get projects moving. And when I look, recently, as it was 4 years ago, the Egyptian government did a green bond, which was the first in the region, and very well received. And we participated in that. Maybe just to talk about some of the projects. So especially on the ESG front, you really do need a bundle. So we recently participated in a transaction for a very large wind energy project, Red Sea Wind Energy, which is a consortium of equity partners. So you've got the combination of equity coming in, NG, Orascom, which is a local, very large corporate, Toyota coming in, but you also had EBRD and us rolled in. So it's that blended finance model that really worked. And then the export credit agencies. And I think having that strong tie with export credit agencies and that link in, absolutely critical. So for Egypt, the Minister of Finance and the Minister of Investment were here in London 2 weeks ago meeting with corporates and banks. The intent is to bring in FDI and really draw a new FDI in, and that recognition that you really do need the export credit agencies to be able to backstop some of the risk that the corporates are taking by coming in. And really that intent to, again, grow and build up in certain sectors. And that's, for us, it's very much in sustainability and alternative energy. Pharma, a big piece right now. Sustainable agriculture and food security. So there's a very much a focus on bring the business in and then get the bundle of financing together that can make those projects work.
Thank you, Todd. Njord, your focus on one type of financing. Yeah. Maybe you can double click on that.
Yeah, I think, so look, everybody's been saying this for the last 10 years. I don't think it's a big surprise. I think there's a couple major risks in Africa. One, from a private equity side, liquidity. There's just not enough developed markets to be able to sell assets you buy, especially in the banking sector or any sector. So it just adds that combined with the FX risk on a lot of these markets, it becomes very challenging. And that's why I think you see all the development finance institutions have really been focusing on debt, because there's a exit mechanism inherently built into a transaction. Where in private equity, there's a challenge to get out. And so when we look at transactions, before we even think about valuation, before we even think about do we want to make the investment, we think about how are we going to exit a transaction. If we're buying a small microfinance institution in Uganda, who are we selling that institution to when we have to liquefy? Because we have, it's a limited life fund, and we have to sell after 5, 7, 8 years. How do we get out of these markets? So that's the biggest challenge, I think, in the financial sector in most countries in Africa right now, is that you just don't have a market developed yet that would allow you to do these type of transactions in in a, I would say, a normalized or a sustainable way. We spend years trying to exit a transaction. We spend a longer time exiting a transaction than getting into a transaction, which makes it challenging from equity side. And that's why the debt is, I think, is more consistently available in the African market.
So maybe taking off my moderator hat and putting on my private equity investor hat, of course, I echo your observations. We've been successful in delivering exits in Africa. But over the years, I think it's definitely the multi-market businesses are more attractive for strategic buyers. Businesses with the highest level of governance are more interesting for strategic buyers. Single country businesses, especially in slightly smaller economies, are more challenging to exit. As I mentioned, multi-country or the big markets around the corners are definitely more attractive for strategic buyers. Capital markets, other than South Africa, which has been kind of like slightly stable, but capital markets probably is not as liquid and do not offer really the sense of safety or the level of liquidity required. So would the securitization programs change that? Like, is this going to work across regions? And perhaps Olivier can cover that and cover an important question, because we talk about Africa as one market. You focus on one region. So is Africa really one market, or is it multiple regions? And maybe your observations around how securitization programs are working in your core market.
Okay.
And if you have the knowledge about the other markets as well, would be very helpful.
Okay, thank you. So is Africa one market? So far, from my perspective, Africa is on the way to become a one market, but you see, Africa is talking about 54 countries, and each of them have its level of development and its own regulatory frameworks, the economies, and etc. But there are some effort of regional integration, like in West Africa, for example, where we have a common capital market which unify 8 countries, and in Central Africa also we have the same initiative. So Africa is more some blocks like West Africa, Central Africa, but some initiatives are also in the way to create this one market. But this will need some harmonization of regulatory. For example, even in this West Africa common market today, with one regulatory framework, we are still facing some specificity in each country, like tax policies and all that. Regional authorities are taking some decision to, unify all this, but countries are taking their time, to implement all that. In this context, securitization comes to provide an additional instrument of financing to both governments and corporate. As we know, over the world, securitization have had a great impact in terms of financing, like infrastructure, financing, even banking system. But so far, we are, I think, on the good way to develop and impact all this. We have an increasing number of players in securitization sectors. 3 years or 4 years ago, we were only 2 or 3 licensed companies which were operating securitization. Today we are 6, and each of us are trying to impact and provide new financing from the capital market, because today, except some countries like South Africa or Nigeria or some northern countries where capital market is really developed, we are still on the way to work on it. Maybe because on the point of savings from the population, you are saying that in terms of liquidity of capital market, it wasn't so liquid, and this is one of the challenge that you have to address, because yes, some international investors can come from Europe, from America to invest, to impact in financing, like green bonds, like social bonds and else. But we have in our region by ourselves to raise and collect savings, enough savings to finance by ourselves the development need, because the need is there in terms of infrastructure, in terms of all this kind of core structural project that we need to impulse to launch really the economic and social development of the countries. And yes, Africa Link Capital Titrisation is trying to play its part of this by sensitizing investors around the world to come and invest. We have been doing it during 5 years so far, and we are also promoting securitizations and capital market overall to the economic players and government as an option to finance the needs to impact our countries.
Thank you. Thank you, Olivier. Maybe views from colleagues representing other parts of Africa, so from the south and the north. Do you actually believe that the regions are getting into integration? Do you see similarities? And do you believe that the opportunity is there to look at Africa as one region, or we're not there yet?
Yeah, I think my colleague has already said the fact that, you see, Africa is spoken of as a single market, but in reality, when you look at it, right, it's a continent made up of multiple distinct economic blocks with different economic profile, different regulatory environment, also different currencies and so forth and so on. And of course, thanks to the continental free trade agenda, the AFTA, because it seeks to unify the continent, not only in terms of trade, but also in terms of financial integrations as well. But one thing that we must appreciate when it comes to the continent is that different blocks or economies are at various levels of financial integration. And if I may bring your attention, maybe let's say to the SADC regions, for instance. The SADC also presents diverse economic profiles. When you look at South Africa, you'll find that it's by far the most developed in terms of your capital markets, banking regulation, and banking infrastructure, regulatory frameworks, and so forth and so on. But then, when you take South Africa out, then you also have, other profiles that features in, and you'll see that you have what we call the middle income economies, like your Namibia, your Mauritius, and all that. They're very relative, stable, let's say, banking, sectors with a growing level of financial sectors and integration. But then when you look at the low-income countries like your Malawi, your DRC, Zimbabwe, and the rest, those are actually still far. They still face so much instability and regulatory challenges and so forth and so on. So why is it really important to actually understand these various distinctive profiles of the African economy. It is because of, this diversity means that for banks and for investors operating in Africa, right, you must be flexible in adapting to their operation and the various needs, to the specific needs and the specific regulatory environments and frameworks that actually dominate the various economies and geographies that we're actually looking at. So in a nutshell, I think, we are working towards unifying the continent. Yes, there are various agendas which are good, like the AFTA and other ones that are trying by all means to actually make sure that at the end of the day there's integration. But at the moment, one still needs to appreciate, if you are an investor looking in Africa, you need to take cognizant of all the various distinctive elements that we mentioned and of course we are facing, so that it helps you navigate the environment, the African environment from an investment perspective.
Thank you, Vukosi. Look, actually, Todd and I were chatting about this away from the panel I spent some of my time covering India, and of course, Todd, you spent significant time in Asia. And if I look at India, it's 1.5 billion people roughly. It wouldn't be very different. Africa's bigger in terms of scale and resources. But India is one market that is heavily integrated. And they've done, over the last 5-10 years, they've done a lot of work around the digital infrastructure, around trying to get cash sucked out of the economy and bringing informal economy into the formal economy. So the outcome is, just think of how many billion-dollar businesses that came out of India and the level of infrastructure projects that are happening there. So probably we need to definitely, as an observation, that's one big thing that as a continent we need to work on, is how to integrate these regions, because obviously at the moment the integration is not there. So Todd, well, would you agree, and what are your observations on this?
I do agree. And I think it's the regulatory integration that really becomes critical, but it's so hard to do. It's so hard to do. But once that happens, I think that transformation, that digital transformation, and certainly goes very, very quickly. And the informal economy starts to I guess, be absorbed into the formal economy. When I moved to China, so it was 9 years ago, so I'll just tell you how quick this went for us. And my wife and I would go on Saturday morning for breakfast, and there's a very elderly lady in Puxi that would make jinbang, which is the big pancakes on a drum, and she was making it outside, and you had to put money in the little bucket she had. She'd cook all morning. There'd be a big lineup, and when she was out of food, she just packed up, and that was it. And we'd gone there for a few months, and then we were away, came back a month later, and she was now on WeChat. So she was doing, everything was on Alipay or WeChat Pay, and it was interesting. She no longer accepted cash, like none. And you had to pay. She had a QR code you scanned. It set off a bell in her stand, so she knew you paid. And her productivity, much, much faster. But also we realized she got an order of eggs in. She paid for it using her WePay, and she became part of the banking sector. And I think that transformed so quickly, and she just no longer would accept cash. So it was interesting moving to Egypt, where everything is cash-based, everything. And how inefficient that is. So I think if the regulatory environment is right to encourage that move to digital, it transforms the economy. And but that to do it across all the countries, that's a big ask. That's a big ask.
Well, look, it's of course, as efficiency, offer her financing options, but also brought her to formal economy, because now everything is invoiced, there'll be taxes paid, so there is a clear incentive.
Well, and she's got a credit history, so she's got the ability now to start borrowing based on her cash flow.
So, thank you. Look, I think we touched on the uncertainty part. We touched on the financing, and I think this last point, touching on the transformation that we're seeing and we hope to see. Perhaps maybe the last topic is many of my colleagues on the panel touched on the ESG point and the impact point, and linking this to financing. So obviously there is quite a big focus from the various financing options available on the continent on the impact side. And I think the question that, given that we are a private equity investor for profit, but we are also an impact investor, we're fortunate because we invest in one sector, which is the intersection between technology and financial services. So impact just comes naturally with everything we do, and we take ESG as a hygiene factor. That actually we believe it's highly linked to financial outcomes because we invest in businesses that we help them to apply the best governance standards. And the question we're regularly asked, and probably you're the best position to give your views, is does impact compromise returns, or can you have positive impact and make money?
Yeah, that's a great question, and I think it depends, right? So it depends on what your intent is with your impact investing. There's a broad spectrum of impact investors. Some of them are focused really on the social side. Some are focused more on the commercial side. I think if you look at sort of market returns from a fund perspective, it's a mixed bag. You see that some mainstream private equity probably does some couple hundred basis points better on the return perspective. But then also there's a broad spectrum of who is investing and what you're really focusing on, right? From a company standpoint, having a impactful mission, it certainly has helped them receive funding. You see, over the last, even in Africa specifically, over the last 20 years, there's been a lot of money flowing into small financial institutions, microfinance institutions that otherwise would not receive funding from anybody, right? That's just to be honest. People are willing to take the risk, willing to provide funding, and they're paying higher multiples on these investments than they would at traditional banks. And why is that? It's because it's the social mission of the organization. So I think definitely from the receivers, the banks, the microfinance institutions in the financial service sector, they've definitely benefited from having impact. And it's good business really to have this social mission, right? So you're able to attract different types of talents. You're able to differentiate yourself in the market as well. So there's a lot of really good business reasons to do impact. From an investor standpoint, it depends on what type of impact you want to do. For example, the Digital Transformation Fund, we play in the same space. We're investing in financial institutions that are trying to digitalize the financial sectors, digitalize the banks, digitalize the clients. And what you end up having is you end up getting reducing the cost of the financial institutions. You're able to expand the outreach. And you're able to do that in a customer-centric manner that it allows you to attract new clients to the financial institutions. So for example, in India, we have an investment in a large NBFC, a large microfinance institution, where they are providing digital financial services to rural women, older women, and they created a just-in-time product where they can go on their phones, their flip phones, their mobile phones, and get just-in-time financing for anywhere, where they can go to an agent and get out the money, right, to pay. So these type of sort of value creative solutions is really both impactful, but also is helping the organization grow their business, helping them reduce costs, and helping the overall the financial returns of that company. So if the financial returns of the company is better, us as investors will also benefit from that. So it's a yes, but it's a maybe. And it also depends on timing, right? Because a lot of these projects are long, they're time-consuming, expensive, and you have to make sure that you have the patient capital in place to be able to do digital transformation. So that's why when we invest into companies, we want to invest with like-minded investors that have the same sort of time horizons that we do, because if you're exiting in 12 months and spending all this money up front, you're not going to get the financial return, you're not going to get the social return that you expect. So having these like-minded investors going together to do these strategies on the digital transformation is very important.
Sure. Thank you. Look, definitely this is, we're fully aligned on the yes part, because obviously our funds are very successful in terms of dollar IRRs, and we still benefit from the positive impact, but perhaps it's also linked to the area we focus on. So we heard the bell, so probably we just have some time for questions, but are there any final observations on this question of impact versus return from my colleagues?
I think the impact side is, for me, it's a yes, it's a benefit, because when we look at all our countries, part of the population is really in needs of this kind of financing, and this should enable this part. When we talk about social financing, gender financing, and all this financing is the objective to enable this population to be part of the system, to be part of the economy, which definitely should impact the development of the countries.
Thank you. So we have 5 minutes or less left. So perhaps if there are any questions from the audience to my colleagues on the panel. There are mics at the back. So if you have any questions, please put your hands up and a mic will come to you and we can address the question. Okay, there's one question here.
Thank you very much. This question is more specifically for Olivier, because I know you've worked in the CFA market, CFA space in West Africa. I'm curious if you have a view at what scale, if it's, what type of revenue that countries in some of the smaller CFA markets have easier access to financing. If there's sort of a cutoff point that you see in the market, whether in terms of project size or scale as defined by revenue of a company, where suddenly access to capital becomes more available, and also where you see the major trends in non-traditional bank financing occurring in that space, in that region. Thank you very much.
Okay, so the size of financing available for yeah.
Do you see, because I know you work on, sorry, because I know you work on a lot of big projects. Do you have a sense of at what scale the financing suddenly from banks suddenly becomes more readily available in that in that region, in that currency system, whether for projects in terms of project size or companies in terms of scale of the company, and also sort of are there any trends that you see in financing options that are separate from the standard banks that people go to?
Okay.
Yeah.
Thank
you.
Yes, of course. In the region, depending of the size or the profile of the companies of the banking system is banks are more available banking finance for big corporates and government most of the time, and for the smaller one, you should address microfinance institution to cover their needs, or given that some SMEs or very small entities are not really, in terms of governance and management and a contency formal, they struggle to get financing. But for example, the capital market, the stock exchange is implementing a compartment, especially for SMEs, to address their needs on the capital market, because what we noticed so far is it's only the banks, formal banks, that is financing the economy, where the most of economies is SMEs is the huge part of the economies, and we should find a way to address these needs. We are talking recently about basket bonds, to finance a portfolio of SMEs, maybe which are acting the same sectors, or which are, so some ideas are being promoting to address the need of this small size of business, so that this can impact the development of the entities and the whole economy.
Thank you. So we ran out of time, but we have one question here, so maybe we can address it quickly. Yeah.
Maybe I will wait for the mic.
Yeah.
Question for you, Hassam, either for you or for Nior, given you are global investors. Do you differentiate between the impact metrics in Africa versus rest of the world?
Okay, so from our point of view, of course, we're a global fund, so we don't have a pre-assigned allocation, but we would like to be diversified. We invested in Africa over the years and across the regions, and the criteria is the same. It's basically needs to tick the boxes of ESG, high impact, and return. There is no different lens, even with our developed market fund, where we believe that the impact element is not limited to growth markets or emerging markets. You can still have positive impact investing in in developed markets.
Yeah, I think from my side, I think there's a slight nuance for each region, right? So you can have different types of impact in different regions. In India, you can reach 5 million clients making 2 investments. In Africa, you can do something else. So there's a different variety of how you're going to have the impact. So each company itself, not just each region, but each company itself has a different type of impact that you can have. So you're focusing on what is that impact of that investment you're making, and what is the thesis, and how do you develop the KPIs for that institution, and making it all individually tailored to the situation, the country, the type of clients you're serving.
Thank you. So we ran out of time, so I think the last task is to thank my colleagues. Thank you very much for joining the panel, and thank you all for joining. Thank you. And now hand back to our session, to the session chair.